Prices in the US are still roughly 20% higher than they were 5 years ago. Rent, groceries, and insurance have quietly recalibrated to a new normal, while wages have mostly crawled. In this environment, keeping your money in a traditional savings account doesn't build wealth. It just slows the financial bleeding. Compare that slow economic bleed to the version of wealth we see online. Social media pushes options trading, leveraged ETFs, and 20-year-olds in rented Lamborghinis. It sells high-risk, short timelines, and massive daily swings. Humans evolved to prioritize the immediate and the urgent. We are biologically tuned to ignore slow-moving processes that don't offer an instant reward, which makes the multi-decade growth of an investment portfolio feel invisible to our instincts. The mathematical reality is that you do not need a crypto miracle to reach your first $100,000. Historically, you only need $500 a month. The catch is that the process of getting there is excruciatingly boring. Building six figures depends almost entirely on your relationship with delay, the ability to let a number sit uncelebrated for a decade while everything else around you insists that waiting is for people who don't know better. Before we start the clock on that $500, we have to route the cash through a highly specific, mathematically optimized sequence. First, if you have a 401k with an employer match, you capture it. If your company matches 50 cents on every dollar you contribute, that is a guaranteed 50% instant return on your investment, regardless of what the stock market does. Once the match is locked in, you take the remainder of your $500 and route it directly into a tax-advantaged account, specifically a Roth IRA. Because you contribute to a Roth IRA with after-tax money, it sits behind a legal tax shield barrier. The IRS cannot touch a single dollar of the growth that money generates. When you withdraw it in retirement, you pay zero taxes. Finally, you fully automate the entire sequence. The transfers must trigger the exact same day your paycheck lands. Without strict automation, you are relying on willpower, and willpower loses to weekend trips, expensive dinners, and forgotten subscriptions before the money gets invested. This graph maps time against wealth. At year zero, your automated $500 a month begins flowing into a broad stock market index fund. By year 5, you have contributed roughly $30,000 of your own money. The total account balance is sitting at about $35,000. At this stage, the process feels like a scam. Because the overall balance is still relatively small, early portfolio growth relies almost entirely on the physical cash you are contributing every month. This unimpressive flat period is where the vast majority of investors quit to go chase a high-risk trend. They don't fail because the financial math is broken. They fail because their patience runs out right before the curve on the graph begins to bend. If you stay invested at historic market averages, the account crosses $60,000 around year 8. Then the line bends sharply upward, crossing the $100,000 mark near year 12. Let's break down that six-figure balance. Nearly half of that total was not deposited by you. It is money compounding on itself, growth generated entirely by the account while you were working, sleeping, or watching TV. This acceleration happens because of the rule of 72, a mathematical constant showing exactly how long it takes for a compounding asset to double based on its rate of return. The money no longer relies on your physical labor. It has gathered enough mass to generate its own independent forward momentum. Hitting $100,000 is a threshold of mass, not a finish line. The exact same mathematical forces build the next 100,000 in a fraction of the time. But right as this momentum kicks in, many people get a raise at work. They increase their spending, but leave their automated investments sitting at that original $500. This is lifestyle creep. You end up running on a financial treadmill that keeps getting faster, exhausting new income while your net worth stays flat. To defend against this, route a strict percentage of every raise into your automated investments before it gets absorbed by your daily lifestyle. Every dollar of lifestyle inflation that outpaces your investment growth is a dollar permanently stolen from your future self. The most successful investors in history rely on this boring strategy. They lean into index funds because guaranteed arithmetic is vastly more reliable than luck. That $500 serves as the first domino, a catalyst used to unlock the one resource compounding can't create more of: time. If this mechanism is mathematically documented, repeatedly proven over decades, and fully accessible to you right now,
What are you actually waiting for?